Hello and welcome to our webinar today on the tax benefits of conducting research and development here at home in the U.S. and abroad in other markets. Glad you're with us. You have a couple of options for listening to today's webinar. You can listen through your computer or you can change and listen through the phone. If you would like to change your audio, you can go up to the audio tab, click the triangle next to the word audio. It will open up and there will be a radio button to choose phone call if you'd rather, and a telephone number will appear there for you to dial in with. We will not be offering CPE for this session today, just to make sure that that's clear for everybody. We do have a questions pod. If you have questions that come up during the process during the program, please enter those there. Our speakers will try to get to those as they come up, but if not, we do want to address those after the program and we'll be able to reach back out to you. And we're very much interested in issues and questions you have, or if you'd like some more follow-up training on some of these areas or more information. Also, if you look down in the handout section of the gray command strip, you'll see one for handouts, and in there is a copy of today's slides if you'd like to download those. So let's get started with our materials. Our speakers today, Brian Dill. He is a principal with our firm and the leader of our international tax services, and has spent much time and focus working with companies operating all over the world, multinational organizations, and particularly in the space of innovation. And Ron Wainwright, he is a partner and a leader of our credits and accounting methods, and spends a good bit of his time dealing with research and development credits in particular, as those have benefited numerous companies and our clients in particular. So we're going to cover a lot of areas. We're going to start with Ron talking about an overview of the U.S. R&D system and how it works, and then he's going to highlight two of our European regimes that involve refundable credits. That's what we're focused on today in that arena. And then we're going to switch over after that for Brian to be talking about sort of the landscape and the multiple issues and questions that have to be dealt with in trying to figure out what's the best place to optimize intangible property as the companies operate in many markets around the world. So with that, Ron, let's get started with an overview of the U.S. R&D credit, because I think that's a basis for talking about all the credits, no matter where they are.
Oh, so thank you, Sarah, and thank you all for joining us today. We hope the next 50 plus minutes will be informative, educational, as well as enlightening in regards to a number of the new foreign regimes when we think about the R&D tax credit. So a little bit of framing before we dive into it is, what is the U.S. R&D tax credit? It is a federal tax incentive that has been in the Internal Revenue Code since 1981 and is permanent in the tax law. It is designed and was designed in the late 70s and when it became effective in 1981 to promote innovation, to encourage and incent companies to design and develop new and innovative products and processes and software and techniques and design, and has literally driven the U.S. economy since that time. So when you think about the R&D credit, it is primarily a labor-based incentive. What does that mean? It means that as companies incur expenses that are research and development oriented, or ultimately what are referred to as qualified research expenses, as we'll discuss, you're gaining a tax deduction. And then the incentive is, it's a subsidy, in that you take those same costs incurred, the same expenses you're deducting, and it generates a credit. So when you think about the opportunities, think about activities towards developing new or improved and more reliable products, processes, software, techniques, designs, formulation, etc. It is, in fact, a subsidy from the standpoint it is a dollar for dollar offset against the tax liability of the taxpayer in the United States. If it's a pass-through, it goes to the underlying. if in fact it is a C corporation, it is captured at the C Corp level. And 40 plus states have adopted the R&D credit in the United States since 1981. And we'll talk a little bit about some provisions. Any provision that's been in the tax law since 1981, as you can understand, the long life and long history is one, extremely complicated, and therefore there's a lot of myths. And we'd like to kind of dispel some of those myths surrounding the R&D tax credit. So there doesn't need to be a eureka moment when you think about new and innovative products and processes. Doesn't need a number of individuals running around in lab coats with Bunsen burners and beakers. And it's just not for the space shuttle. That's often a question. Well, I thought R&D was, space shuttle oriented or some just, eureka moment. And the answer is no. In fact, since 1981 in the U.S., not different than other regimes across the world, which we'll talk about too today, there doesn't need to be this discovery test. New and innovative is actually a specific taxpayer test. So it must be new and innovative to the taxpayer. So let's talk and kind of summarize some of the qualifying industries that we have done work in, as well as are applicable to this R&D. Each one of these tiles we have done work in as a credit and accounting method team at Jerry Becker. And you can see from these tiles the broadness of the credit in regards to that it's industry agnostic. And it really is applicable to any taxpayer in the United States or abroad, because to continue to compete, taxpayers must consistently be looking at designing, developing, formulating new and improved and innovative products and processes and software. And you'll see a cadence here. So there are a number of tests in the statute. Most talk about the 4-part test, which is a standard. There's also a 7-part test in the statute. But when you think about the permitted purpose test, it's really an activity has to relate to a new or improved function of a business component. And that's where that business component is a product, a process, et cetera. Business component really means the activity which the taxpayer is selling or leasing or licensing, if it were software oriented. In other words, a business component is something that a taxpayer uses in a trade or business to basically differentiate itself from its competitors. The standard is technical in nature. We want the new and improved product or process or business component to rely on a hard science, not in essence a preference. So hard sciences are engineering and biology and physics, as you can see. There always must be some form of a technical uncertainty, a question mark at the beginning of the R&D effort. Usually, and by statute, technical uncertainty is defined as the capability of the taxpayer to develop this new or improved business component. What is the method of developing or improving an existing business component? And then ultimately, what's the appropriate design? So in technical uncertainty, the standards are capability, method, and really process, or what's the appropriate design. And then ultimately, all R&D must have a consideration of one or more alternatives to resolve that, quote, technical uncertainty. And in anything, one can argue that always in a alternative or one or more alternative considerations. And so when you think about the qualified services and the types of qualified services, next slide, please. You need to think in regards to what am I doing in conducting the R&D? Well, who are the people that are directly supervising the R&D? And then who are those people that are directly supporting? So as we mentioned, it's a predominantly labor-based subsidy. And so all three of these wage types of these individuals that are performing the R&D activity, those that conduct, those that directly supervise, and those that ultimately directly support. But when you think about excluded activities, I want to make sure we cover this as well, is that research conducted after the beginning of a commercial production will not qualify. Now, one can argue in the advanced world we live in and the continuous improvement culture we have and taxpayers is that you're always in and you really never achieve commercial production. Some industry standards as an example, when you think about technology, most software/technology companies will release a software at about 70% complete. That is not dissimilar to a manufacturer who may, on a first product run and actually distribute, upwards of 1,000 units before it ultimately reaches commercial production. But once you achieve that commercial production, cost incurred and the subsidy available then stops. An adaptation of an existing business component designed to meet a specific customer need will also not qualify. But the key term there is adaptation. We often find that enhancements are occurring really when you think about a particular customer need. They're asking for a specific function, a specific feature, and that will qualify. General market research and surveys will not qualify. Advertising, as you can tell, those are not hard science oriented. And as I previously commented, aesthetic changes to style, taste, seasonal designs, etc. usually, and I say usually, do not qualify because two industries that are heavy users are the cosmetic industry and the apparel industry because there's shrink back rules in the statute. And then for U.S. purposes, the R&D activity must be on U.S. soil. So if the activity is occurring in a foreign country, we'll talk today about UK and Germany, then of course regimes have their own R&D credit in regards to, and reverse engineering will not qualify as well. So let's move on in regards to how much is the credit. It actually, worst case scenario was 6%. The alternative simplified credit method is 14% and the maximum is 20%. So in the US, it ranges from 6 to 20% of what is referred to as total qualified research expenditures, those costs being incurred that ultimately qualify pursuant to our statute in the US. But again, those QREs are wages, supplies, often what are referred to as relock or rental or lease cost of computers, a lot of development being done in the cloud. So any type of web service deemed to be a supply. And then ultimately, as you outsource with respect to contractor services, so 1099 type people, or if you outsource an element of the development, that will qualify as well. You are allowed to amend returns for open years, normally as long as the statute of limitations is open, 3 years. Or you can go backwards in time in the United States as long as the taxpayer was in a loss position. And so we've done studies on very large pharmaceutical public health companies that had a drug in development 20 years, and we went back and captured the R&D credit and pulled it forward to minimize their tax liability upon FDA approval. Generally, a carryback is 1 year and carry forward is 20 years in the United States. So let's move on now and ask ourselves, well, understand the federal credit, understand some of the basic provisions of it. Well, I will tell you that in the United States, as published by the IRS, of all eligible taxpayers in the United States, less than 35% of those taxpayers claim the credit. The majority of them understate the credit. So even though it's been in the statute since 1981, it is a complex area and often misunderstood, as we've said. But 40 plus states, actually 47 now, have adopted the statute and have their own R&D credit regimes or provisions. It often follows the federal rules, and states actually use it more as an incentive from the standpoint of recruiting companies in their states. So I'll give you two examples. Virginia and Maryland are both refundable credit states. Next slide, please. So when you think about Virginia R&D credit, they actually have two regimes. Major credit, which is for a company with more than 5 million of quote qualified research expenditures in Virginia. And they have a $20 million pool they allocate out of. and it carries forward 10 years. And usually the award rate is about 22%, obviously higher than the U.S., ranging from 6 to 20, as we've discussed. They have a minor pool, so that's for those individuals where your quote QREs are really less than that $5 million mark, and you get a 10 to 15% credit up to 300,000 of QREs in what's referred to as your base amount. So anybody below 5 million is going to be eligible. Not dissimilar to the U.S., they have two methodologies. And normally the award rate is about 40% of the applied, because the current pool in Virginia is about 7 million. So now let's move on to Maryland, a second refundable credit state. Regardless of your quote tax liability, they will write you a check, not dissimilar to Virginia. Again, two types of credits there. So as you can see, states use it as an incentive. You got a basic credit at 3%, and then you got a 10% of what they call growth credit. Refundable for small businesses, and recent award rates, because they have a pool as well, is about 15% or a little bit less. So before we go into the next slide, which we want to begin to talk about the foreign side, I want to give you some information around that less than 35% claiming the credit in the US, and in turn, the majority of them understating the credit. So in the United States, in 2016, the most recent information we have, that less than 35% of US taxpayers at a federal level claimed $15 billion of credit that reduced their tax liability. Next slide, please. So let's think about now foreign regimes, which is really what's happening worldwide. Is the European countries have really always had, but we've now seen some upstarts in the United Kingdom and Germany. We wanted to show you the refundable nature of what's happening on a worldwide basis in the event you're a multinational. So when you think about United Kingdom, some of the terms are going to look almost identical in regards to financial support and tax incentives for innovation in the United Kingdom. It sounds very eerily similar to what US is about in regards to incenting people to develop new and innovative products, processes. So the regimes worldwide are very similar. The research-led tax incentives in the United Kingdom, such as the patent box and the R&D tax regime and the R&D expenditure credit, are various incentives in the UK. But what we wanted to do is cover with you today, next slide please, a couple things that have changed in the UK. So very similar to the refundable credit, credits are awarded based on the company's expenditures for the research. It can reduce its tax bill with the offsetting credit, dollar for dollar, or it will receive a cash payment for some or all of the credits. In the United Kingdom currently, and this is a new regime, there's two opportunities. For small and medium-sized enterprises or SMEs, it can generate cash payments of up to 33.5% of the R&D spend. So think about, you spend €1 million, or pounds, I should say, you could ultimately achieve 330,000 pounds of quote cash payments. And then there's what's called the REDEC, which can generate cash payments of up to 8.8% of the R&D spend. We do work across the globe. So now let's move on to the next slide and talk a little bit about what activities qualify for the credit. There's a little bit of tightness more in the United Kingdom, so specific projects that ultimately make an advance in science or technology. No social sciences or theoretical fields. So they similarly tie it to a hard science. Ultimately, it has to relate to a trade or business, which is not dissimilar to the US. It must address a new process, product, or service, or improve an existing product, process, or service. Very similar to the United States. Very similar to the US, you have to document what you looked at in advance from a science and technology perspective, i.e. that, quote, assessment, that technical uncertainty. How did you overcome the uncertainty, going back to the capability, method, and process at the beginning, and how, under a process of experimentation, did you ultimately overcome it? and that ultimately it could not easily be worked out. Now that's kind of a subjective term. In the UK, there is no competition or call for applications or peer review process to earn the credit. It is self-assessed or self-claimed, very similar to the United States. Next slide, please. So when you think about the United Kingdom and the R&D relief provisions, SME less than 500 or 100,000 pound turnover, profitable, you deduct an extra 130% of qualifying costs. So we're seeing this regime change throughout the world, where in the US you get 100% deduction. Some countries are now allowing a phantom deduction if you're profitable up to 130%. Ultimately, you could get to a 230% category. If you're not profitable, you simply claim the credit, which is about up to 14.5% of what would be deemed to be in the UK a surrenderable loss. Large companies, a little bit different. Prior to December 2017, about 11%. Post December 30, 2017, 12%, and then upwards of 13%. So you can see it's kind of aligning now with, quote, the United States. Next slide, please. And so now we move into Germany. Now, Germany is very interesting because they did not have an R&D credit, but normally the European Union had the concept of innovation patent boxes, which is a regime to tax at a lower rate based on an R&D revenue stream. But in Germany, they announced in January, you may claim the credit up to 25% of the declared R&D expenditures. So again, not an application process, et cetera. Credit only applies to wages, so you don't get the benefit of, quote, supplies and computers as you do in the US, as well as independent contractors. Interestingly, initially the credit, and it is a refundable credit, I want to stress that, was limited to 500,000 euros, and it was due to the pandemic increased to $1 million. And ultimately it's about 25%, as we said. So, to get, in essence, 500,000, you were spending 2 million. And now underneath the regime, if you identify 4 million, you're going to double the size. Again, the credit applies against tax payable currently or is added in the net tax assessment refund. Next slide. Next slide, please. So then the type of R&D projects that qualify, companies' own internal R&D projects, very similar to the United States. Cooperative research projects with universities qualify, not necessarily dissimilar to the United States. And then contracted research, credits awarded to customers and not the R&D contractor. So again, the customer who's contracting, that third party, similar to the US regime. And then ultimately, the contractor must be based in the EU or the EEA. And then the contract research credit applies to 60% of the contract value, where in the United States it's 65%. Next slide, please. Eligible R&D activities follow EU definitions, very similar, basic, industrial, experimental. Pure product development in the context of a simple routine, not eligible. That's where that language is subjectivity. No one knows the definition of simple routine. Very similar to an old standard in the US law of common body of knowledge. Companies in Germany must apply for a certificate by certifying to the body that these activities qualify. So it's still a self-assessment. It's just that you're sending in a certification. And then the process of timing for the refundable credit, again, that up €1 million in the euros in the pandemic, and or 500,000 in the regime really beginning January 1 of 20, is estimated to take about 3 months. So, from a German perspective, significant refundable credits, same concept in the UK as well from a refundable perspective. Let's go to the next slide, and then I want to make a comment before I turn it over to my colleague, Brian. Next slide, please. So when you think about the United States regime and the refund opportunity in the United Kingdom and Germany, we cannot in the United States have we do not have a federal refundable. But one of the changes that came about in the Tax Cuts Jobs Act of 2017 was we actually put in place a regime where all of the costs incurred currently are expensed. So you get to deduct it, not unlike what we saw in the UK and Germany around the phantom that hunches up to 130% or maybe up to 230%. So in the US, effective January 1 of 22, there was a change underneath the Tax Cuts Jobs Act where we would have to capitalize and then amortize those costs over 5 or 15 years. The reason I mention this is because my partner will talk about the importance of where your IP sits and all of the considerations as we work with a lot of multinationals. But last evening, just to keep you updated, that's why I don't have a slide, Representative Larson, who's a member of the House Ways and Means Committee, which is in the House of Representatives in the United States, introduced a new piece of legislation called the American Innovation and R&D Competitiveness Act. It's HR 1304, which would repeal the capitalization. Now, interestingly enough, if your IP was in the US, you amortize over 5 years. If your IP was abroad, which is where Brian will talk, it was over 15 years. So it is expected that there will be a companion bill introduced into the Senate next week, and prior to 12/31 of 21, that provision that was put in place January 1 of 18 will be repealed in full to make the United States more competitive. So I hope this has been informational and educational. We are available at the end, but now I'm going to turn it over to my fellow partner from an ITAX perspective to talk about offshore activities and developing and profit sharing, all centered around your IP, and obviously all R&D has an intellectual property nature to it. Brian?
Ron, thank you very much. I appreciate it. There are a lot of things on the cross-border aspects when it comes to R&D and intellectual property ownership. And I think the three big takeaways from mine, if you remember anything, is that because of the 2017 Tax Act in the US and similar actions overseas, IP planning and R&D focus is in a state of flux, and we'll go through that. The second major thing is if you hear of a benefit in a particular territory, you really need to think about it from a global perspective, because that benefit often can be offset by cost in other countries. And number three, anytime you're going to go offshore, the intercompany transactions, today transfer pricing is just a great big deal. So let's get started. The way we here at Cherry Bekaert try to look at IP planning and R&D is really in these particular bullet points. And it really is, at the end of the day, where are you going to own your intellectual property? Is it onshore or offshore? And that's both from a legal perspective, and in the tax world, where's the economic ownership? So oftentimes you can register a patent, have legal ownership in a particular territory, but the economic ownership can shift to a different jurisdiction. The third thing we'll talk about is who conducts those research and development activities. Are you going to use employees? Are you going to use third parties? Are you going to outsource those type of activities? And then how are you going to structure your R&D services? Are you going to do it through a branch of your U.S. company? Are you going to set up a subsidiary? Are you going to look for joint ventures or third-party arrangements to accomplish this? And alternatively, are you going to contract for the performance of services? Then we also look, which is the big deal, the tax benefit. What is the global tax benefit of where you're going to locate your IP? What's the tax rate? Is a deduction allowed? And also, what's the effective date of that tax benefit? Sometimes those tax benefits or tax holidays can run for 5 years. Sometimes they're deferred. And as Ron talked about, R&D incentives, that is one aspect, and we work with Ron's group all the time. Is it a current deduction? Can you get a tax credit? Is it refundable? Tons of opportunities there, but it has to be taken in the context of complete IP planning. We also help with regard to what type of intellectual property. Is it patents? Are you going to self-develop the IP? And we'll work with your attorneys across that, what kind of intellectual property you're looking at developing. In this next bullet point, type of qualifying income, how you structure your transaction. Is it going to be embedded in the product and in the pricing? Is it going to be through an exit? Are you going to sell the IP? Or are you going to have royalty streams? Are you going to license it? So that has a big impact upon the taxation of your IP. Royalties are often subject to withholding taxes, whereas if you embed the IP in the product and it's in your product pricing, oftentimes that sale of that product is not subject to income tax in that particular jurisdiction. And then there's the other one is the activity requirement. Where is the research going to be performed? Which countries are going to be performed? So, and let's go to the next slide, Sarah. I think the important thing here is on the next slide is thinking about the old rules. What were the old rules in tax planning? In the U.S., certainly from 1986 on for the last 30, 40 years, but really since 62 in the Kennedy administration, tax planning when it came to IP planning was move it offshore. U.S. multinationals transferred the economic ownership of the foreign IP to low tax jurisdictions. It was a no-brainer because essentially you were able to shift the tax on the value of that IP and the profit derived from that IP from a 35% rate jurisdiction, oftentimes, and you read about it in the press, where they were often paying 0% or very low tax in foreign jurisdictions. So it was from a thought process, what should I do? It was a no-brainer. Get your IP offshore and generate income offshore because the tax savings was tremendous. And foreign multinationals did the same thing. Current and future state, however, where are we? Like I mentioned, we'll talk a little bit about U.S. tax reform recently. We'll talk about IRS and the foreign controversies. I'll also talk a little bit about DEPS, which is known as base erosion and profit shifting, and it's called, the big things we'll talk about are called DEMPE and CIGA. And DEMPE is really, where is the development? Where is the enhancement of the IP? Where is the maintenance of the IP? Where is the protection of the IP? Where are you going to do that? And then where are you going to exploit it? We'll talk a little bit about that. And then CIGA really is about your core income generating activities. So new acronyms always coming around. Other structures that other countries use is Ron mentioned R&D credits, like the German credit, but there are also other jurisdictions that have what we call patent box regimes that provide very incentivized IP planning. And then the other thing is, in a state of flux is the IP definitions. Are we talking about IP for tax? Are we talking about IP for financial statements? Or are we talking about IP from a legal perspective? All three have different treatments, and it's very important that you distinguish that. Also, from an acquisitions and IP and integration, what's your exit strategy? How are you going? Is it going to be cash flow? Is it an exit strategy? That could be very important as to how you plan your IP. So, formerly, it was push it offshore. Today, with tax reform and with uncertainty, it's not as certain today. Now, moving forward, next slide, Sarah. What's changed? In the U.S., what's changed is that we have fundamentally changed the way we tax in an international sense IP. So we have base erosion and anti-abuse tax that we never had before. We have new export subsidy opportunities in foreign-derived intangible income. So that can be as low as 13.125%. We now have a new anti-deferral regime in GILTI, global intangible and low tax income. So what that really means is that you're paying current year tax on foreign profits. So that used to be able to defer your income offshore and that 0% idea. Today, with the GILTI regime, you're no longer, and you have to go through that exercise to determine whether GILTI is favorable or not. In many situations, GILTI can mean no additional tax here in the U.S. but oftentimes it could be an additional tax. In the EU, we have new anti-hybrid and excess interest rules, so that if you are operating through as Ron referred to, a flow-through vehicle, and you're operating through flow-through vehicles in foreign jurisdictions, are you going to run afoul of the anti-hybrid rules? And then we have the participation exemption, where there's an opportunity now to bring back income from your foreign companies or subsidiaries back to the U.S. on a tax-free basis. And then the basic foreign tax credit regime has changed tremendously. And then, of course, there are new definitions with regard to intangible property. So what's changed? Everything's changed. So we had been operating under the same international tax rules since, for the most part, the Kennedy administration. There were some changes with transfer pricing in the 80s with the Clinton administration and the regulations that came out, and then, of course, case law. But for the most part, it has been the same. Next slide. So what's changed in the EU? EU, as I mentioned, they have new anti-tax avoidance directives that we have to navigate. And then, of course, as I mentioned earlier, the base erosion and profit shifting. So the idea of just shifting profits and placing it because you've deemed it to be the IP is, for example, in the Caymans. These new DEMPE or development, enhancement, maintenance, protection, and exploitation functions, where is the substance? So it really appears, and they are following through on this, is that what we used to be able to do by placing IP in foreign jurisdictions, by not having any employees and setting up shell companies, those days are for the most part over. And you really have to think about what kind of substance you're going to place in the foreign jurisdiction and what kind of R&D activities are actually going to take place. And then the other thing is, are you going to have a core income generating activity that's going to be in that foreign jurisdiction? So what we call CIGA functions, are you going to have those functions in that foreign jurisdiction? Third thing on BEPS is country by country reporting. So you will have to be disclosing for transfer pricing purposes your master file of your global transfer pricing and country by country reporting of your intercompany pricing. So jurisdictions are much more sophisticated today. Jurisdictions want to know what you're doing on a global basis for your intercompany pricing. And the idea of just presenting them one side of the story is not as easy as it used to be. Next slide. IP location from a U.S. tax perspective, what's changed? And there are opportunities to do R&D offshore and to locate IP offshore. So let's look at the numbers. If you have U.S. rights today and you're exploiting it in the U.S., your rate can be anywhere from the 23 to 25% rate. If you're going to take those rights and exploit them overseas through export, that can be as low as around 13 1/8 or 14% under what we call FDII, or foreign derived intangible income. So there's some real export subsidy opportunities here for those companies that are exporting out of the U.S. through the FDII operation. Outside the U.S., for U.S. rights, you can be as low as 10 to 12% here in the U.S. under the GILTI, and same thing for the foreign rights, depending upon how you exploit it. So GILTI regime will permit you to get down to that 10 to 12% regime. So it's the fundamental fact that what the U.S. tried to do from a tax policy perspective here is they really want you to no longer produce IP offshore, and they're trying to put a benefit back here in the U.S. so that you're exploiting that IP out of the U.S. That's the basic premise behind the tax policy there. The base erosion and the BEAT tax, absolutely you have that to think about. And as we talked about earlier, DEMPE, which I will repeat, development, enhancement, maintenance, protection, and exploitation. Where are those things related to the IP, and where is that going to take place? Next slide. IP location from a U.S. perspective continued. We really think it's important to think about your total tax profile of the organization. So there are R&D credit opportunities. You can exploit things offshore, but you have to take into consideration, are you in a loss position? What's your overall profitability? Do you have the ability to hire and put employees or put activities in a proper jurisdiction? And what's your foreign tax position, tax credit position back here in the United States if you're going to put R&D activities overseas? Are you going to be eligible for the credit? Do you take on a lot of leverage and maybe you can't take a foreign tax credit? So we really take a look at it from an overall global tax perspective. Is if you're going to think about exploiting IP offshore, if you're going to think about taking advantage of R&D credits, how does that impact your overall global tax position? Also, many of you are associated with private equity or investment vehicles. How does that flow through to the owner and members? How does that impact them and their foreign tax credit positions? And is that favorable to them? And we operate through that often. Operational and company treasury considerations, what we mean there is, from a financing perspective and a cash flow perspective, how are you going to get the monies over there? How are you going to get the monies back? Do you have the banking relationships? What is the net effect on tax through intercompany financing arrangements? What do you do if you're cash pooling or sweeping amounts through your treasury functions and you don't want the cash in that foreign jurisdiction? What are the tax implications? And of course, for those of you that are doing financial statements from a GAAP perspective, what's the ability to realize those deferred tax assets? Though it's NOLs, we can also help you through there. And then ultimately, what's your exit considerations? Once you're able to sell and once you're ready to exit, what is going to be the impact on exit on where you structured your IP if it's overseas? What if the buyers want that IP back in the U.S.? What's the cost of bringing that IP back into the U.S.? Is there an exit tax out of the country to get that IP back in the U.S.? So all of those considerations are things we walk through in helping you organize your IP and whether it should be onshore or offshore. Next slide. I'm going to go through these next ones pretty quickly. The OECD, or Organization for Economic Cooperation and Development, and base erosion and profit shifting, I mentioned those earlier just a little bit. The OECD, I will just say, for decades, the OECD and U.S. Treasury were somewhat aligned in their thinking, even though they were a little different. I think the OECD now are challenging current arrangements, challenging current thought, and that just knowing the U.S. tax rules is not going to be sufficient. I'll mention this in a slide here in a second. But, the OECD, because of developing jurisdictions and some actions out of the UN, are much more focused on whether you have employees over there, what a level of substance. And they're also thinking about, the Apples and the Googles of the world that are based here in the United States and exploiting their consumers. And what does that mean for them? Should there be taxation if you're exploiting the IP in a foreign jurisdiction because of their customer arrangements, even though you have no activity? Those are the type of things the OECD is tackling right now. And they're somewhat at a loggerheads with the US because honestly, the U.S. is leading from a technology perspective. We have the largest companies out there from a technology perspective. And the OECD thinks that could be somewhat unfair for those developing jurisdictions that are using that technology, but not reaping any of the benefits of the companies being able to sell and exploit their IPs in those foreign jurisdictions. So just some of the things that are operating from an OECD environment. Next slide. DEMPE, like I've mentioned before, it's really about where are you going to locate the development of your IP? Where are you going to enhance your IP? How are you going to maintain it? legal protections, and as I talked about in the last slide, exploitation. Where's the exploitation of that IP going to occur? Where are your customers located? And so the U.S. has always interpreted, as I say here, a profit split, based upon some of these activities. But the U.S. has not fully embraced this idea of DEMPE, largely because of the exploitation and because of some other technical details I won't go into today. But by and large, those are things I think you should consider when you're developing ITP and exploiting IT. Where does it need to be located? How are you going to exploit it? And that the U.S. taxation is not the only thing, especially if your customer base is not just the U.S. Next slide. Some key considerations for DEMPE. If you're going to self-develop it, where's going to be your design and control? If you're going to acquire IP, how are you going to defend it? Especially if you do acquisitions and you are going to acquire IP and it's going to be offshore IP, where is that going to be located? And then key components in establishing the DEMPE, where is the IP going to be located, is where's the legal title? What are the contractual arrangements that you're entering into? Where are the employees associated with this and what are their responsibilities? And of course, management oversight and who has oversight of the DEMPE consideration. Next slide. Another thing that's happening is a core income generating activities. We're seeing this a lot, especially in tax haven jurisdictions with respect to IP development, financing, and holding. There's new legislation, even in tax haven jurisdictions, with respect to you can no longer just have a shell. You're going to have to locate core income generating activities in the jurisdiction that's going to hold the IP. Otherwise, there might be fines, penalties, or you may even be deregistered. And certainly the EU is looking at this. Next slide. Talk a little bit about transfer pricing very quickly here. Transfer pricing, so now you've gone through the idea of where you want to put your IP, where your IP should be located. Now, on a global basis, you've got companies in one jurisdiction, companies in another jurisdiction. The next thing is going to be, what's the intercompany pricing? And the things we help you walk through really are the idea of an arm's length principle. Where is, what's the right charge out rate? Should it be cost plus? Should it be a profit share? And then the idea of many of you out there, should your IP be centralized in one country? Should you decentralize your IP? And what does that mean? And we'll walk through the legal and economic ownerships of it. Should you license the IP or should you share cost? So all of those things are important considerations, and those are all transfer pricing considerations and how you should develop your IP. So for example, if you're looking at the German R&D credit, are you only going to, and that the US is going to use the benefits of the activities of Germany, and the US company is going to benefit from that, and then the German company is always also going to use the benefits of your R&D operations in the US. How do you share those costs? How do you not end up with cross-licensing arrangements and withholding taxes? We can help you through those and how you implement a cost sharing so that both own with the IP with regard to their territory, where they're going to actually exploit the IP, and not where the actual R&D operation is being operated. We also can help you through the transfer pricing documentation, the penalties for the non-compliance, whether there's a coordination R&D credit and transfer pricing study, so that you don't, the left hand is not talking to the right hand, that you're taking an R&D credit and saying that you have research and development activity in one country, and then all of a sudden the transfer pricing doesn't reflect that. We see that all the time, that we'll see on the tax return, or we'll see the evidence of an R&D credit being taken, but then all of a sudden the intercompany pricing doesn't reflect those R&D operations. And so the intercompany agreements and making sure that your R&D activities and the credit and transfer pricing is aligned is a really important consideration. And we see that more often than you would think, that the left hand is not talking with the right hand in those particular circumstances. Next slide is what I mentioned to you briefly is centralized versus decentralized IP ownership. Just briefly, because we're running a little bit out of time and I wanted to leave a little time for both Ron and Sarah here, is, centralized IP ownership really creates a situation where you're almost always going to have some type of licensing or royalty arrangement because it's centrally owned in one jurisdiction. So unless that IP ownership is in the very same jurisdiction where your manufacturing and your principal arrangement is, a lot of times that's a licensing arrangement. And if you're going to license, the big issue there is withholding taxes. And what methods are you going to do to determine what the royalty rate will be versus a decentralized IP ownership where you have the opportunity to own IP in various jurisdictions and share it based upon the jurisdiction where you're going to exploit it. That can eliminate the opportunity for an intercompany royalty and excess withholding taxes. And so we go through that. And so a big part of today's global tax planning is that fundamental issue. Do you want your IP to be owned centrally in one jurisdiction? Or do you want to be decentralized and have a cost sharing arrangement where the IP is going to be owned in the jurisdiction where it's going to be exploited? And we can go through this, but they both have advantages and disadvantages, and they just have to be rolled into a kind of a totality or global perspective. Next slide. Transfer pricing documentation. When you do IP management, you're going to have transfer pricing documentation. You're going to have U.S. transfer pricing reports. Like we mentioned earlier, you'll have to have master and local files for all of your countries. And there's penalties for non-compliance. Some countries are statutory, like India and Mexico. If you don't have compliance, they can reach 100% penalty. In the U.S., the penalty is you can get out of the penalty if you have a contemporaneous documentation that goes along with your tax return. So if you have completed your transfer pricing study and you put it in the files and it's contemporaneous with your U.S. tax return and it meets the necessary requirements, even if the IRS does make an adjustment to your transfer pricing, you would not face penalties. Like I said earlier, we coordinate with the R&D credit studies because if you are going to have research and development activities and you're going to take a credit, you've taken certain positions about where that IP is going to be located, and your intercompany pricing needs to reflect what you have reported for purposes of taking that benefit from an R&D credit perspective. And then finally, on documentation, if you're going to document what your pricing is, you need to have the intercompany agreements in place to reflect your intercompany pricing. So the legal arrangements between the companies need to mirror what you're actually documenting from both an accounting and transfer pricing perspective. And I think that's it, Sarah.
Great, thank you, Brian. And I think you make one of the last bullets on here about executing these documents at formation at the start. Not so much after the fact brings value, but these are not static documents either. Things change, and we've seen that particularly here in this pandemic as supply chains have been disrupted. It certainly behooves us to go back and look at these arrangements again and the documentation.
And I cannot mention enough, to go through that exercise and to do it, like you said, at formation and not after the fact. And we see a lot of times, and especially we've had clients in these particular circumstances that some did a great job, others did not, on the execution of their documents. And in this pandemic, what's occurred are those that have gone through the document execution process. There's standard language we like to see from the attorneys, and one of those things are force majeure clauses. And guess what? In a pandemic, you know, you can impose those force majeure clauses in an intercompany arrangement. So for those that had the force majeure clauses, you know, they're able to get out of recognizing a profit in a particular jurisdiction, whereas the others might not. And it all came down to the document execution, where now for 2020, we have clients that fortunately are not going to have to recognize income because of their intercompany arrangements, because they had these special clauses in them.
Right. And Ron, really R&D for any company that's trying to stay cutting edge and continue to grow and develop, they're spending money on all kinds of things, particularly here, even in the middle of a pandemic when production seems to slow or businesses tend to slow down.
Good comments. What I would say is we are seeing actually more R&D activity that meets the 4-part test or the test abroad. Obviously, the United Kingdom and the German regime were very intentional with respect to the quote credit, refundable in nature. So we are actually seeing, because companies needed to react, pivot, modify their processes, change their product. You mentioned the supply chain elasticity, cost problems. And so all of those changes that were being developed almost on a real-time basis, attributable to that business component of a product, process, technology, software, et cetera, all are qualified research activities and in turn cost. So cash is king and a dollar is a dollar, and certainly a refundable credit is very important.
All right. Well, Brian and Ron, thank you very much for your insights and conversation today on these issues. And thank you, audience, for joining us. We really appreciate your being here as well. There will be a copy of this presentation posted on our website in a few days. So you'll be able to pull it back down and take a look. Thank you again, and join us next time.